All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
Terrific. You're in Los Angeles, Katie, but we have had this unbelievable run of weather for almost 2 months. It's been sunny every day and no rain and very moderate. It's a little cooler this week, finally, but we were in the 60s and 70s, sort of like Los Angeles weather for almost 2 months now. And I mean, sunshine every day. It's a little weird because there hasn't been any clouds at all. So not only is it warmer, but it's sunnier than it usually is, and there's no rain. And we're in a sort of drought situation in New York, New Jersey, parts of Pennsylvania at this point. And so it's wonderful because the weather's been fantastic, just unbelievably great. But it's also a little worrisome because there's no rain. So, good news and bad news, I guess, out there.
Yeah, very strange for this time of year. I know Thanksgiving's just a couple of weeks away. Do you have any holiday traditions?
Yeah, I traditionally, for the last 10 years, we abandoned our family, sort of an anti-Thanksgiving thing. And Suzanne and I usually go on a little trip together, and we're going to do a very short trip to the Caribbean for a few days. My family has forgiven me. We spend a lot of time in December with our family on the whole different weekends in December. So it's great to get away with the wife just somewhere and go away somewhere by yourself.
Yeah, well, I hope you enjoy your little vacation. Well, we have a lot of questions to get to today, Bob. So first up, we saw this post-election market rally. Will that continue, and what's going on there?
Well, you see, it hasn't actually. We topped out last week in the S&P. I think we're down 2% this week. So just think very simply the way I think of the world. What drove the S&P was at a new high prior to the election? What drove that? What drove that was a still strong economy. Let's not nitpick. It was still strong and really great earnings. We're going to have earnings were expected to be up on the S&P 10% this year. And that's about right. It's been that way the whole year. The expectations have been very steady. And basically, it's happening. The expectations are very strong for next year, 15%. Now, that's probably, who knows? That's probably too optimistic. But nonetheless, that's what drove going into the election. After the election, historically, there is a pop, no matter who wins. And there's a pop because you get this uncertainty removed from the market. And uncertainty is something that sits in the market and kind of puts pressure on the market. After the election, there's usually a bounce no matter who wins. Usually S&P goes up 3-4% into the close of the year. In this case, there was a bigger bounce because a Republican sweep was not priced into the market. That's what mattered here. You might say, oh, well, Trump was not priced in. And actually, in a way, there was expectations there earlier. What was not completely priced in was a Republican sweep. So what happened here is all of a sudden we got an additional bounce on things like expectations of stronger merger and acquisition activity, expectations of less regulation helping certain companies, more likelihood of legislation friendly to crypto. That's why crypto bounced, why Bitcoin bounced. And then there's the potential impact of tariffs. We don't know what's going on with that at all. Nobody does. But there are implications if there are more for countries like Mexico or China. So all of a sudden, on this Republican sweep, there was a lot of money that just suddenly moved around. And it happened very, very fast. This is the great thing and the bad thing about modern markets. Stuff moves really quickly. And essentially, the post-election rally is kind of over, but it was over at the end of last week, practically. Like I said, we're down around 2% this week. We've really been, sideways since last Friday and drifting lower as the week concludes. S&P, all the big indexes, Russell 2000, triple Qs. The Russell 2000 had one fantastic day right after the election. And essentially, yesterday we were down 4 days in a row here. I'll give you another example. We had, at the end of last week, I think there were 400 new highs on the New York Stock Exchange. And, yesterday there was, less than 100. So, and the overall volumes are back to normal. So there was huge volume in the week last week. And it's sort of gone back to normal. So I wouldn't call this a sell-off, but definitely enthusiasm is waning a little bit, and it should be. I mean, how far can you push this thing, for crying out loud? I mean, we're at 22 and a half times forward earnings. These are very expensive multiples. We have seen notable inflows, money going in. I watch ETF flows. It's a good short-term sentiment indicator. Still going into technology stocks, cyclical stocks like industrials. No demand for defensive stocks at all. This is a sort of strong spirits rally. And that tends to favor cyclical sectors, not defense. Defensive stocks are like consumer stocks. So Pepsi's gone nowhere. Coca-Cola's gone nowhere. Smucker's, think of these names. I don't know who else. General Mills, Brown-Forman, the liquor maker. Brown-Forman owns Jack Daniels. Gone nowhere, really, all year, but the last few weeks really have gone nowhere. You got a strong dollar. That's not good news for gold. Gold hit a new high, but gold is sort of more of a defensive thing in a way. And when you suddenly get a lot of risk on, gold goes down. Look gold's down since the election. That's because the dollar strength and risk on doesn't help gold too much. So the bottom line is, this has been one hell of a move, and it's not surprising that we pushed it about as far as we can right now.
So, Bob, you touched on this in the last question, but what does a Trump presidency mean for investors and what should they be considering?
Yeah, I did touch on it. Look, we saw stocks that were involved in M&A activity move. We saw stocks that were cyclical stocks that moved on prospects of lesser regulation. We saw some pressure on foreign country ETFs like China and Mexico on concerns of higher tariffs. So a lot of this move has already happened. We saw odd things happening. They nominated RFK Jr., Robert Kennedy Jr., for Health and Human Services, which a lot of people said, you've got to be kidding me. But we saw a little pressure on vaccine stocks, for example. Now, who knows if any of that's going to come to fruition at this point? We have no idea. So there's a lot of speculation around all of this. Again, keep your eye on the big picture. People somehow think that presidents have dramatic influence on the stock market. Generally, they don't. Now, Trump did in 2017 because he cut corporate taxes, 35 to 21%. That was notable, and that did have an influence on the stock market. So there's an instance where a president did make a difference. But in general, most presidents don't. Now, this particular Trump 2 term may in fact have some outlying effects. This one may be an anomaly as well. But keep your eye on the big picture. Keep your eye. There is $16 trillion indexed to the S&P 500. You can own the entire S&P 500, which is 80% of the U.S. stock market, in a single stock. And increasingly, that's what people do. The U.S. stock market is about $60 trillion. About a quarter of it is indexed to the S&P 500. That means a lot of investors are just going along for the ride. This is why I talk about this. When I say earnings are expected to be up 10% this year and 15% for the S&P 500, you can bet on this as a stock by owning the S&P 500. And about a quarter of all the money is in that. That's why this is so important. So you see, when I tell you keep an eye on the big picture, overall earnings trends, yes, it's true. A small group of tech stocks is responsible for a significant part of those earnings trends, but you own the S&P 500. You're part of that trend, so you don't have to worry. This is why indexing has won out. This is why passive ETF investing has become so big, because people want to just be part of the market. They're smart enough, and they're also smart enough to know that picking stocks is extremely difficult, and generally you do not outperform the market. So those of you who think you can do market timing and guess what the Trump presidency might mean for specific sectors, go ahead, knock yourself out. Most of you are not going to want to do that, and most of you are going to find out it's better to have a plan, to know how much money you want invested in the stock market versus the bond market, or versus paying off your mortgage, and stick to that plan and stick to it for a long time. I mean, if you're 35 years old, you're going to live another 60 years. That's a long time. Think way past all of this. And remember, it's time in the market, not timing the market that matters. That's an old saw, but it's like most cliches, it's true.
Yeah, I think that's definitely a helpful perspective for everyone, Bob. Our next question, we can talk a little bit more about crypto. Is it worthwhile to invest in Bitcoin now?
Look, I have been very blunt about my position on this. I do not think, I'm just talking about Bitcoin here. Bitcoin is a cryptocurrency that runs off blockchain. I don't think that Bitcoin has proven a strong use case. I understand there are people who intellectually think that fiat currencies are inflationary and Bitcoin is a protection against that. It's an interesting intellectual argument. Most people I know invest in Bitcoin as a way to get rich quick. They can't even spell fiat currencies. So I'm sorry. This is a get rich quick scheme for the most part. I do understand why people want to own it. The pros here is it's high risk, high return, and some people do want it as a diversification. There are arguments to try to argue that Bitcoin is a separate asset class, along with real estate, stocks, bonds, commodities, cash. I don't think it has proven that case yet. The cons of it is it's a, as I said, limited use case. I do not believe it is money in a historic sense. And I don't think it's proven itself as a store of value, certainly not like gold has been. Gold is a store of value, it has a much more historic relationship. Let me say, and I've been very vocal about this, I am more optimistic. I am bullish on blockchain technology. I am bullish for decentralized finance. I am bullish on smart contracts because this is truly disruptive technology. This kind of stuff for use in property transactions, sending money, stock settlement. I'm really very excited about all of that. But that's a very broad use case. You see, those are really great use cases that are out there. This can reduce, blockchain technology can significantly reduce financial friction. So I'm all in, 2 thumbs up on blockchain technology. On a specific use of blockchain technology, which is Bitcoin, a cryptocurrency running off a blockchain, I am less optimistic, less bullish on its use cases. But I am not opposed to it. And when the Bitcoin ETFs were floated, I very enthusiastically supported Bitcoin ETFs because if you were going to do it, a Bitcoin ETF is a far safer environment. We had all these problems with people losing passwords, getting stolen in these stupid Bitcoin depositories that were out there, and it was just not safe. So why should people get ripped off or forget their password? Own Bitcoin ETFs. My philosophical concerns are not as important as people being able to do things safely. There's a lot of things that I think are foolish for people to do, but there are safe ways for them to do it. They're going to lose money, but that's their choice. So I supported Bitcoin ETFs despite all that. I know that was a little bit, long-winded, but it's important to sort of separate Bitcoin from blockchain, which is a far more diversified use case that's out there.
Our next question, Bob, is will we see more IPOs this year?
Oh boy, this is a boring subject. I mean, it's not boring. I've been covering IPOs for 25 years. I've never seen years like this. The last 3 years, 2021 and part of 2022 was really good. But essentially the last 3 years have been horrible. I mean, way below historic averages. 2021 was a big year. And there's a few reasons. Part of it was the COVID interruption, but part of it was during 2021, there was enormous amounts of money raised in the private markets at very high valuations for these companies. And the public market does not want to value these companies as high as they were in the private market. So these companies stay private longer. And that's been a problem. For them to come public, the public markets are going to give them a haircut, and they don't want to do that. So in theory, this is a great time because the stock market is at a new high. There is a belief that interest rates are moderating. That's a little bit of a wild card, but economic and market conditions are good. So, and yet we're getting another subpar year. There are some big names out there: Stripe, Instacart, Shein, the Chinese fast food retailer, Databricks. Databricks, though, did try to do a private funding round. There's Discord. What else is out there? Klarna, the buy now, pay later. They filed confidentially to go public. Unfortunately, it's too late this year. So filing confidentially means that they'll make a statement and the SEC is going to review it, and it'll take a few months. It'll probably be, I don't know, January, February before they go public. They've been floating around for years. Again, this is this problem with valuations. I don't know how many companies, as long as they can sense that they'll get private funding and it'll keep them going, that's a good thing. And number two, the thing that would put pressure them into going public was their shareholders, their employees. After a few years, they've got all these shares. They want to monetize the shares. Historically, it was difficult to do that. Now there are private markets, NASDAQ, Forge. There's people out there with these private markets, and you can go and have private sales. So this is this very much relieves some of the pressure on these companies to go public. And I think it's probably a good thing, but it prevents companies that say, oh, why we don't need to go public yet. Maybe we can get a higher valuation if we wait another year. So here, the problem I have with this is these companies, by the time they go public, they're middle-aged. They're old. And so the investing public itself doesn't have a chance to invest in them. This is why there's this mad scramble to get into private equity and private debt. And you see ETF companies tying themselves into knots, trying to get in on the market. But it's very difficult to do that. So it's very frustrating for the public markets. I'm hopeful maybe we can come up with some legislation that'll make it easier to go public. A lot of companies don't like the red tape associated with it, but mostly you're exposed to public valuations. That's the big problem. And I don't have a problem with that. You want to take money from the public, and the public has a choice of whether they want to buy this thing at your price or not. And that's called the real world. So I don't have a problem with that.
All right, and then our last question for today, kind of looking ahead at the last couple months of the year, is there anything that could be potentially market moving that you're watching that investors should know about? Well,
going into the end of the year, some of the Trump appointments are going to be a big thing. I mean, obviously, like nominating RFK Jr. for HHS but that'll be resolved eventually. One thing that's kind of amazing to me is how little effect geopolitics has had on the stock market. The two big things in the world right now are Ukraine and Iran, and all of those are potentially very explosive. I would watch that very carefully. There is this feeling seems to be that you could get some kind of peace deal in the Middle East, but it might involve some kind of regime change in Iran. I don't know if that's possible, or if the current regime would agree to make a deal. But the Saudis certainly seem interested, and the the Israelis certainly seem interested. Given that this creates a lot of problems with global shipping, I would think that would be a good thing if some kind of peace deal could happen. Ukraine is a real wild card at this point. I don't know, but so far they've had very little effect on global stock markets. Again, I look at these earnings situations, expectations of 15% growth, tech stocks continuing to do pretty well. Energy stocks are not, because energy profits are down, but the energy companies are very little influence. Exxon and Chevron accepting, it's a fairly small group. It's about 4% of the S&P. You'll have decent growth in global industrials, strong growth in technology, some growth in communication services. So again, if you own the S&P 500, you don't have to figure out, do I want to own healthcare in this environment? Are the hospitals going to be winners? Which Medicare provider is going to be a winner or not? If you own the S&P 500, you don't have to figure that out. If you want to, it's very interesting intellectually, but you'll find it very treacherous, because you're going to have to figure out some time to get in and then get out. And your market timing may or may not be right, and your estimation of what's going on may or may not be right. So there's a lot of opportunities for you to be wrong on those kinds of guesses. This is why, again, I'm sorry to harp on this, this is why indexing and passive investing has won out, because your game is to stay with the market, not try to second guess the market and what's going on. Just consider this. We were up more than 20% last year. We're up 25% or so this year. That is a remarkable run. That doesn't happen very often. We're up 50% since the start of 2023. So $1,000 in the S&P 500 in January 2023 would be roughly $1,500 today. In 20 months, 21 months, 22, that's kind of amazing. That doesn't happen. Historically, the long-term average growth of the S&P 500 on a yearly basis is 8, 9, 10%. If you add in the dividend, which you should, it's closer to 10%. And the dividend of the S&P is about 1.5% a year. So, we're actually up, instead of 25%, we're up almost 27% this year, if you do the math, including the dividend. And you should reinvest the dividend. This is incredible. Imagine you trying to time this and figure out, when should I get in and get out? If you would have done it, you would have missed out on the market. Probably on days when the market was up, you would have been out, and you would have missed one of the great bull markets of all time, the last year and 10 months. So this is the part of the game I keep pounding away at. Time in the markets, not timing the markets. Have a plan. Stay with it. Stay long. Stay invested. If you have some strong convictions on NVIDIA or Apple, whatever you want to believe in, take a small part of your savings. Jack Bogle at Vanguard used to say, play with 10% and go ahead. But if you know how to calculate your gains and losses, your P&L, profit and losses, as we say, accurately, Bogle always said, over time, you'll find out you're not going to beat the market. That was Bogle's belief. He founded Vanguard on this idea. And you see how big Vanguard is these days. So there's my personal investment belief. There's more of that in my book. Shut Up and Keep Talking if you want to talk all about the history of investing. And I even talk about what I own. And not surprisingly, S&P 500 is the core holding for what I have. So I practice what I preach. And I hope that what you'll learn to do is be a steady, long-term investor. That's the game here. Steady and long-term.
Well, I think that's a good note for us to end on this week. Thank you to everyone who sent in questions. Thank you, Bob, for your answers as always. And we'll talk to you again soon.
Thanks, Katie. Thank you, everybody.